We were looking at the in-the-money covered call positions a moment ago for our discussion with Mike, who's doing covered calls and is concerned about the sell warnings that are appearing. The monthly and weekly picks of the day. These are criteria that Ernie put together after extensive testing, 75 to 80 different iterations of using in the money, at the money, out of the money covered calls, looking for high volatility, looking for low volatility, avoiding earnings, not avoiding earnings, looking for positive earnings per share growth, not worried about positive earnings per share growth. If you click on just the monthly picks of the day view, you see the top two, which is based on his historical backtesting and trading process. And so we click on see how we develop these results, and it goes through some of the concepts, what he found when he was doing these tradings, things that you would think would, oh, okay, well, naturally, we're always going to get a higher return by selling out of the money with the appreciation. Yeah, but in the wrong market conditions, you don't get as much protection. The losses pile up faster, and it takes you much longer to get back to break even. Okay? So in addition to the proper structure of what performed best over these testing periods, with the limited amount of management, not overthinking it, not trying to always say, oh, I need to roll down, I need to roll up. Simple rules of entering positions, looking for a high success rate. Here, his success rate was 85% of the trades were winners with an average of 3.9%. And he had to enter to stop position, and he entered a stop originally at, let's say, 5 or 6%. He was getting stopped out too much. It wasn't profitable. Lowered it to 10%. Was getting stopped out too much, and positions that ended up getting closed for a loss would have recovered actually and become a gain. So he decided to set the stop loss a little bit lower than you'd probably like. But on average, yes, he took losing trade 10.7% of the time. But again, making 3.9%, winning 85% of the trades, losing 10.7%, 15% of the time, it returned the best results consistently with the different types of stops, different types of criteria, and so forth. So why am I going through all this? Well, Yogesh's question directly was, on your monthly covered call search, let's go back to the search where we could see all the results. He says most of your recommendations are stocks that have risen significantly in price over the last month or two. Why is this? I, for one, am worried about the downside, which can also be significant. Okay, this was similar to Mike's question that he asked at the beginning of the presentation, Yogesh. I'll put your presentation with Mike's, this discussion with Mike's discussion. And that was, he's interested in doing covered calls, but he's seeing the sell warnings pop up on the market sentiment. Is now the right time to do covered calls, or what should he do? Now, let's take a step back, Yogesh. The reason why you're seeing stocks is because of the technicals Ernie's using that he found worked best consistently during the trading periods and the testing periods. He's looking specifically for stocks that have had a MACD positive cross signal 5 days or more, that they've been on a consistent run. He found out that worked better than trying to bottom feed, trying to find stocks that were at the lower range of the Bollinger Band or had a negative MACD crossover, but the crossover MACD gap starting to get less. Trying to find positions that were under their 20-day moving average, but looking like they were starting to tick up with a positive RSI. They did not perform as well. Bottom feeding did not perform well. Okay? They talk about the trend is your friend, of course, until the trend ends. And that's why you're seeing those ones that you feel are hitting at the top. Okay? So the question is, what can you do to be safer? Well, this is what we kind of talked about. I like the monthly picks of the day criteria. I know what Ernie did, and he's looking for positions that are slightly in the money with a good potential return if assigned and a good downside protection. But if you wanted to go more protection, he's already 10% in the money, but if you wanted to go with more protection, worried about more of a downside, the first alternative, if you're worried about a market decline but still want to get income with the covered call strategy, go deeper in the money. Let's increase this up to 15%. Let's increase our downside protection to be at least 10%. I think most of those on the top page were. Make some subtle changes. Go deeper in the money for more protection. Increase the downside protection. We're still seeing the same results because they're well within what we're looking for these types of positions. Okay? We are avoiding earnings, if I'm not mistaken. Yeah, we're avoiding earnings between now and expiration. We're looking for these as well. Now, if you have some set of criteria in mind, Yogesh, where you prefer to look for stocks that are under the 20-day moving average, but are moving away from the lower Bollinger Band and have had, although the MACD is negative, it's recently had a positive crossover, you can set those settings. I just know that how many iterations Ernie went through for the monthly picks of the day and the weekly picks of the day, he probably went through those iterations and they weren't as successful as what he's starting off here with the monthly picks of the day and the weekly picks of the day as well. Okay, and the follow-up to that is, let's say I like Marathon. I see this good slightly in the money covered call at the 9 strike, a high downside protection, high percent return if assigned. Yeah, although it did drop, what, 30% today, 28% today? It was at 13, it dropped 3 points. It's probably at 14, it dropped 3 points. So we're talking a fair percentage there of a decline. I understand that might make you nervous. But the other alternative to going deeper in the money to still find a good return and a good downside protection is, instead of just the downside protection, consider doing a long collar on this position with a different structure. Let's just go to the profit and loss chart. Here's the covered call we're seeing that's slightly in the money. Now, I know based on everything that I've said that I would trust this approach consistently. I'm not saying Marathon is going to be a positive return position. What I'm saying is the structure that Ernie was looking for with the fundamental criteria and the option relation to the underlying stock price has been successful. And it was the one that showed the highest success rate of the ones he tested. But if I wanted to get some premium, but I'm worried about a downturn, and if you're really worried that a stock with a 26%, I think we saw downside protection, such as Marathon, could fall further, because we always saw it fall 4 points today, 3 points today, then what I may consider is picking up the stock at 1081. Instead of going in the money, let's go right at the money. I'm going to go with the 11 call for $2. And I'm going to maybe buy the 9 put or the 8 put. I'm going to start off with the 9 put for about $1. In other words, I'm giving up half of the potential upside to buy a put option in the proper structure for a long collar trade, not the proper protected structure, but for a long collar. And now I can still make 12.7% if assigned if the stock goes over 11. But I've entered a floor to the position that if the stock does tank and drops below 9, I can't lose more than 7.8%. That's a long collar position in the proper structure for a long collar, a standard collar, where my put option is below the short call strike price. My short call is right at the money. We just saw that example on Mike's position, or I'm sorry, when we were on the discussion for Mike E, when we were talking about the standard collar position and the structure we created to have a 3.8% maximum risk for 23 days while still having a 3.3% return if assigned on a more lower and stable stock position. Okay, that's the standard collar. With this stock, you could even probably adjust it a little bit. Let me take out that. Let me go with the 10 and the 8, even though the 10 is slightly in the money. And the 8 strike put is going to cost less. I'm giving up intrinsic value. I'm giving up 80 cents of intrinsic value. We're only going to pay about 55 cents for that put. But we're going in the money, so I'm expecting a lower percent return if assigned. Close to a 1-to-1 risk-reward ratio, 10.7% if the stock stays above 10, and a risk of only about 11.5 or 12%, even if the stock collapses all the way under 8 as well. Okay, this is a standard collar approach. The put is at a lower strike price than your sold call, same expiration date, and you're looking 20 to 30 days out in time. You still have the potential to make a good return to the upside. And with this more stable stock, as we saw with Mike's discussion, we were looking at a 3.3% max return if assigned rather than this more volatile 10%. Okay? But at the same time, controlling risk to almost a 1-to-1 ratio for each trade. As long as you're right 50% of the time, you're going to be seeing good profits. And it doesn't mean that when you're wrong, you're not making a profit. Stock has to fall all the way to $9 before you start losing money on this position, before you hit the break even. And the risk is capped. Now, the long collar approach, the standard collar approach, what I call it. what we just looked at and what's available in the search tool. This is when you're considering doing covered calls. You want to get income, but you're worried about a market decline. You can use the standard collar in that fashion rather than going deeper in the money with the covered call to keep a controlled risk and close to a 1-to-1 or 2-to-1 risk-reward ratio, which can still be beneficial long-term. This is a standard collar. It's a shorter-term income strategy. A married put position is when I'm buying stock outright. This is the follow-up question from Yogesh. The married put that we use is a proper protected structure looking for more upside profit potential. Meaning with a covered call or with a standard collar, that's considered a neutral to slightly bullish position. Meaning if the stock can stay the same or move up slightly, I'm going to make my 2, 3, 4% return or 10% return we saw with that more aggressive volatile MARA position that we were the marathon patent group we were just looking at. But for longer term growth, positions I expect to move up 3 to 5% within the next 20 to 30 days and move up more beyond that long term. What I'm doing is setting a floor on my position for an extended period of time, minimum 5 months or 6 months out in time. I'm planning on being in the position for 3-4 months, maybe, 3-4 months potentially. And I'm going to look to get income to continually lower this risk and leave the upside open. But I'm not generating premium right away because I'm forcing myself into a bad trade. We're going to buy the position. This is the position that was entered today for our Fusion subscribers at Radioactive Trading again. Ritchie Brothers Auctioneers bought stock at 70.57, bought the put at 9.40. Maximum risk, worst case scenario. The absolute worst case scenario, if I do nothing between now and June expiration, the stock is below 75, I'll lose 6%. I accept no dividends. I generate no income. I do no adjustments. That is the worst case scenario, 6.2%, following the rules in the blueprint. If the stock moves up just a couple points, let's say it goes up to 72.50 early next week. Oh, shoot, sorry about that. Even though my cost basis is up to $78, $79, let's say on 12/29, Tuesday of next week, the stock goes up to 72.50, I still have a profit because I'm in a positive delta position of unlimited upside. The married put to me, especially with the radioactive trading approach, is a longer term growth position for core holdings in your account or to add to holdings into your account. It's not a shorter term trade looking to generate income week by week or month by month. That's when I want protection. I'm probably going to be using that standard collar position or consider going deeper in the money with the covered call to still get the return but have the higher downside protection. But in general, I'd be using that standard collar approach if I was worried about a downturn. Of course, I explained why you're seeing the criteria that you see, and that's because it performed the best over those various iterations of the testing period. The married put is longer term growth with more upside open. And I'm planning on staying in the position rather than getting income month by month, week by week. If I'm looking for income week by week, that's what I use the bull puts for in my personal portfolio, or occasionally the long collar position to have protection on something that looks like it has a rich premium, but I'm worried about a 20 to 30% return. In light of that, there was a gentleman I had a conversation with yesterday, an investor, PowerOptions customer, is looking at QS. And he essentially asked me on the QS position of, hey, Mike, I just was thinking about QS. I think he was considering it as a married put. And he said, but the put option that's out to February has a 30% premium. That's not a married put, but should I be selling this put because it's got a 30% premium on the position? Well, I told him that using the naked put screen, I actually found, I believe it was 12 or 13 naked put positions for February, selling puts, as we were talking about with Maurice a little while ago, for that February expiration, 58 days out in time, that were showing more than a 25% yield with just slightly out of the money, 2% out of the money put strikes. QS, of course, was one of them. Let's see here. I apologize. Let's go there. So what I'm doing now is I'm going to QS, of course, And here's, yes, from yesterday, December 22nd, stock was up 36 points. It topped out, I think, 135. And I'm sorry, let me go to puts. My apologies. I thought I was on calls and puts. I just wanted to be on puts. Okay, and I know we're not talking about these $130 stocks, but here is the question about the puts. We were looking at the 130 put, and as you can see here, the naked yield is about 47%. We could go deep in the money, almost to the 120 strike. It's still a 46% yield on the naked put, getting $55, $56. What is this? This is one of those new battery-powered ones, and they announced news yesterday that I think it was 15 minutes of charge for their electric car batteries. 15 minutes on a charger got it to 85%. And this is one that's linked to Bill Gates, of course, and Apple's talking about doing their electric car by 2024. And this was huge for QuantumScape because these are likely the batteries potentially that the Apple electric cars are going to use. I might be misstating that. I think these are the batteries that the Apple electric cars are planning if it ever gets off the line and gets further developed. But as you can see, it's up 40% yesterday. I'm sure all of you saw this at one point. And then again, we hit today. So the 120 strike, we collect $55. You know, we've got a decent break even of 70 or something along those lines, really decent. And we're down to 110 today. Okay, so now we're 10 points in the money, and it's costing us $10 more than we received yesterday to buy to close that put. Okay, and these other ones are still here as well. So it drops another 20 points, not saying it's going to, but it drops another 10 or 20 points the next day. Where are we at now? We're at 90. We're just a little bit away from our break even, and this is going to be running us $85 to buy back. We took 55 in. What's that like? You know, the short put. We collected $55 in premium. It's still dropping. It drops down to 90. It costs us 85 to buy back with this impressive implied volatility. What does that mean? That means that as good as that looked on paper, we essentially bought stock at $85 where the buyback cost on the put would be now, and have to sell it at 55. You're losing 30 points on a $55 cost basis, essentially. That's kind of tough to swallow, but that's what it is. Okay. William mentions that FUBO is another high flyer stock, up almost 100% this month. Yeah, QuantumScape this month alone from 40, peaked out at 130 and it's dropped back down to 110, still above 100%. And William, is just offering FUBO as another one that had done that also. Yeah, look at that last 8 days, right? 1, 2, 3, 4, 5, 6. Yeah, 8 days if we count the weekend there. From 30, peaked out at 62, 62.29. All right, at the high, pulled back down today, 52.59. So the wild rides. That might look great for a covered call if you got in at the right price. Maybe not now. Maybe that's time for a collar that if you're right, you can still make 10%, but you're only risking 11% if it falls against you. Standard collar on a different position as well. I'm not saying this is something I would do as a married put. Why? Because the gentleman that was asking me about these naked put premiums here for the February series on QS is normally a married put trader. And I was concerned that he was thinking about buying this stock at 131, 132, and maybe buying the 140 put out in time, and he was going to be taking a risk of 35 or 40%. That goes against the whole idea of why we use the married puts and the collars. The reason we use the married puts and the collars is to control risk to single digits, 5, 6, 7%, to stack the market odds in our favor. This one looks good because it's 1-to-1, but that risk is a little bit high for my tastes. But again, it's something to consider with the long collar as an alternative to doing standard covered call or going deeper in the money with the covered call if you are concerned, Yogesh, about a pullback. Yogesh, another follow-up question. Want to do one thing here for Yogesh, and then I'll go further into our discussion, Yogesh, if we can, polish up what we were talking about earlier. Yogesh also said, it's safer to do covered calls for dividend stocks. Yes, in a sense. Why? Dividend-paying stocks tend not to move 10, 12, 9% in a day, as some of those higher, more volatile positions we were just looking at do. 15%, 20% that we've seen also. For example, let's just go to the custom spread tool And I'll take my dividend stock that I'm still in right now. It's been moving up good, but it's not something you'd probably consider for a standard covered call. This is more of a longer term hold. This is a married put position for me, and that's Kraft. But if I took Kraft today and let's say I went out to January, we'll go 23 days, stock's at 34.77, somewhere around there. Let's just go slightly in the money with a 34 call at 136. That's a good premium. I'm looking at stuff that I need to do to manage that position in any case. So we're going to do a 34 strike covered call. The stock around 34.60, 34.70, 34.80, my apologies. And a slightly in the money call. Not much, but slightly in the money call. The max return you're expecting is 1.8%. Not 7%, not 8%, not 10% that we've seen with MARA or some of those more volatile positions that showed the higher continuous return through testing and through actual trading with the monthly picks of the day. Those are more volatile. You're absolutely right. But they also gave the highest consistent returns over the testing period. Well, if I wanted to hold this stock long term, I'm trading it as a married put, Yogesh, which I'm doing. If I'm worried about a market downturn, I'm not going to go further in the money because now we're talking about only a 0.4 or 0.5% return. Is it guaranteed, as far as quote unquote safer, that you're going to be assigned early on this position at the ex-dividend date if you're in the money? Well, it depends on the expiration. So Kraft's ex-dividend date, oh, wrong one. Kraft's ex-dividend date, I think, is February or beginning of March. February, okay, sorry, 11/25. So yeah, February 25th, end of February, beginning of March. Why am I bringing that up? So they haven't released it yet, but we can just base 3 months after 11/25. Sorry, that's Smara. Okay. And the reason why I'm bringing that up is that, we don't have to worry about the ex-dividend date till February 25th. So even if I sold the April call now that was slightly in the money, come February 25th, I'm probably not going to get assigned on the April. But then the weekly for the February 26th, or potentially the March 4th or March 3rd comes out, and I have those two sold, and they're in the money at ex-dividend date, those two might be assigned. Most likely the February 26th would be assigned, definitely. Not sure about the March 4th or the March 3rd series. It might not be assigned early around the ex-dividend date. So again, you can't count on the early assignment, but usually the ones, if you're in the money and your expiration is the closest after the ex-dividend date, you can usually assume that you're going to be assigned. Okay. So is it safer? Well, it depends on your outlook. Is it safer because the stocks tend to move less and more gradually, and they're less volatile, and that's a better structure for a covered call? Yes. But if you want higher premium because you're targeting high implied volatility, these are not going to fit the bill for your goals and for your expectations. They're going to be lower premium, much lower return, because they are considered safer by the market. They're less volatile because they're dividend stocks that do not tend to move as much. Okay, now, going into our earlier discussion, Yogesh, I'm going to use your example that you asked me about on the phone, but I had to depart because I had a coaching session and I had to finish up that video that we posted earlier. I don't know your exact numbers, but let's take one of these semi-vol. Actually, I'm going to use a different position. Let's go ahead and use. No, I am going to use that. Okay, I'm going to use that one because it moved up. I apologize. So let's say that I'm out to January on fuel cell and I bought stock originally at around $8 or so. Oh, sorry, add stock, 100. So we bought it right at 9. And at this, or sorry, we bought it at 10. So let's say we bought 100 shares at 10 and we sold it deep in the money, 7 strike call at the time with high volatility for, what would that be, 485, 435? No, too much. I'm sorry, too much. That's the opposite of what I wanted to do. Oh, no, that's, okay, let's just, let me just do this, okay? That's wait, I was sorry, I was right the first time. Anyway, long story short, got a return on this position, got a cost base about 650. I know yours is different, Yogesh. Let's not worry about that. But here we are with an in-the-money covered call position, looking to make a good positive return, and the stock is shot up to 13. And now you say, oh, I want to protect some of my gains on this position. I've sold a 7-strike call deep in the money. Stock has moved up from 10 to 13, about 30%. I know it's very small. But I want to lock in some of this gain here in case the stock pulls back another 30% or so. So what happens now if I go to January and I buy, let's say, a 10-strike put for 55 cents, 56 cents? What's that going to do to my position? Well, this does a couple things. This is the improper structure that I mentioned, where the put is at a higher strike than the call, where you don't really want to do that. Number one, what have you done? You've just created a bearish position. Yes, you were worried about the stock pulling back in this case. But now in order to get the max profit, the stock has to fall below 7. You're worried about downside, but is that your expectation that it's going to drop below that lower strike? We only add a little bit of cost in the position, and we could potentially get $10 back. Meaning what? If the stock's below 10, we force someone to buy our shares of stock at $10. We get $10 back from initial price of $7.05. We make about $2.95 or 41% on that investment. That looks pretty good. Where does this get extraordinarily tricky? It's if your worst fears are right and the stock goes to 6. What happens now? What happens at expiration if I don't adjust this position? Well, you're at a maximum profit. I'm sorry, that's not the worst case. That's the best case scenario. I'm so sorry. That's the best case scenario. In this new structure, Yogesh, you've now created a bearish position when you buy a put above your existing short call strike. So yes, if it goes below 7, what happens? Your 7-strike call expires worthless. You force someone to buy your shares of stock at 10. You only had a cost basis of $7.05, so you make a $2.95 profit off a $7.05 investment. Fantastic. Trickiness now, because this is the wrong structure. The stock goes to $8.50. You have to manage this very soon. You have to manage this somehow. Why? Because if you hold this to expiration and you leave both options alone, both your short call, which obligates you to deliver shares of stock at 7, and the long put, which your broker is going to assume you wanted to exercise to force someone to buy your shares of stock at 10, and you only have 100 shares of stock, some way or another, you're going to end up being short shares. Most likely what's going to happen is if the stock's at 850, your broker is going to fulfill this obligation. You entered a contract to someone else to deliver shares of stock at 7. You have to fulfill this obligation. So they're going to take your 100 shares and deliver that at $7. Okay? Now what's wrong? We're past expiration. We didn't close or roll the positions. Your 10-strike puts in the money, which you would be exercised by your broker, meaning you're forcing someone to buy shares of stock for you at 100. You don't own shares of stock. They had to be covered for this obligation. They were used to cover that obligation that you sold that was in the money. Your put is also in the money. So you're forcing someone to buy shares of stock that you don't own. Come Monday morning, you're going to be short shares of stock in your account, just like if you bought the put only and the stock fell as you expected, but you didn't sell to close it. You held it through expiration. Your broker says, oh, he must have wanted to exercise this put. Since he doesn't own shares, you're now short shares at $10. In addition to being a logistical nightmare because you probably didn't want to be short shares of stock, it's also an accounting nightmare because now you've got to figure out, without the cost of the put, what was the profit that you made just on the covered call portion, and now what is the price of your short share positions, including the cost basis of the 10-strike put that was used to exercise to get you into short share position at $10. And if the stock pays a dividend, now that you're short shares, if you cross the next dividend date, you have to pay the dividend. But you'd likely close or get out of the position before that happened because that was not your plan to be short shares of stock with this overall outcome. That's why it's dangerous to do this opposite structure. We did create a bearish position. So if your sentiment is bearish, hey, you're at a collar spread that's actually bearish. But you've got to be aware of the potential risks and outcomes if the stock is trading between the strike prices, because we're still obligated to deliver those shares. And this put is at a profit, but you got to make sure you sell to close it, because if you leave it to expiration, your broker covers your obligation with your 100 shares. They've got to do something with this. They assumed you wanted to exercise it, which means you sold shares at 10 you did not own, no longer own. So now you're short shares of stock in your account at $10 on a stock that's trading at 8 and falling further. Okay, so the bearish collar has its merits. It is useful from time to time. In fact, I used this a few years ago. Not this structure. What I would have done on Fuel Cell today, if I was bearish on Fuel Cell at the time, is I would have bought stock 100 shares. And if I'm bearish, I'm probably selling the 14, buying the 16. Now, this is going to be done sort of at a debit. And I'm okay with that, because the objective is to create a bearish structure. Now, the common question is, what are you doing? Why are you doing it this way? Why wouldn't you just do a bear call credit spread? And I knew what a bear call credit spread was, but when I first started trading and I only had level 1 approval for my account, and I needed more trades to apply to level 2 and to level 3, where I could do spread trades, all I could do on level 1 and got approved to level 2 was buy stock, sell covered calls, and buy calls and puts. So if I'm bearish, I could just buy a put. But if I wanted to take advantage of a low risk, potentially reasonable profitable position with this level of just stock, covered call, and long call and long put, as we talked to Maurice earlier, rather than risking buying the put and risking 100% of that investment, I could be long stock and enter a bearish position that, if I was right, still make 3.8%. This allowed me to play bearish positions when I couldn't do spread positions and I couldn't use leverage for that first 8-10 months or so. I was just at level 1 approval, because I could do covered calls. It would look like an in-the-money covered call with buying an in-the-money put. And if it just stayed the same or moved down a little, I'd have a profit on this position, even though I was long stock, where on the long put, I probably would have lost value. See, I'm buying the 16 here, the 16 put for 388. That puts my break even at 12.12. So if the stock moves down to 13 and it doesn't do it until closer to January expiration, I'm not at my break even yet. I'm losing money on that long put. Here I'm at a profit of 3%. Gave it a little bit more control. But I don't worry about that anymore, because that was just what I had to do at level 1 trading to get a small premium for bearish positions, but I was using it as this improper structure we're talking about. But I still carried the same risk. If the stock went the wrong way and moved up, I was buying back this call as quickly as possible, because there was a risk there that I would be assigned on the call and then exercise the put, and I couldn't be short stock with that level of approval in that restricted account. That's all. That's all it was. So those were the early days. Did have its benefit. That bearish collar structure had its uses in different market conditions, but that was just for that very specific situation that I was in. But we've talked about the risks of doing this backwards, the risks of, hey, I was in a covered call that looked good. The stock went up. I want to protect it. Let me buy a put that's at a higher strike than the call. That can come with risks if it ends up between the two strike prices, and that's what we want to avoid. All right. Well, ladies and gentlemen, that puts us right at about 5:50 p.m. Eastern Time. I've had some good discussions there on adding protection, being concerned about the downside of the market, alternative ways to trade covered calls, the difference, of course, between the married puts and the standard collar, how their use is for. The standard collar, of course, is more of a, I don't want to say fire and forget position, but it's more of a short-term get income while still having protection, where the married put is much longer term, expecting more growth on the stock, but want to have protection, single digits for several months of insurance, expecting larger growth going forward as well. All right. Well, I just wanted to remind everyone, of course, today that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations, trade recommendations, or trade suggestions. Options do involve risk, as we saw today. The market itself involves risk, as we discussed today, and it may not be suitable for all investors. Now, if you liked what you saw with some of the tools, we focused on the search tool today. We focused on the different strategies using the custom spread tool or profit and loss chart to run what-if scenarios, as well as to run different examples. You can test out the PowerOptions tools at any time. Just go to PowerOp.com, put in your name and email address. You'll have full access to the tools for 14 days. The search tool, using those research and analysis links we looked at, the portfolio tools for tracking and managing, plus the virtual library of options education, and much more. The subscription level starts at just $45 per month after that free 14-day trial. No credit card is required, I should have said, for the 14-day free trial. Subscription level started only $45 per month. We offer different levels of service for delayed data, only 15 minutes delayed or so. That's $65 per month. We do, of course, offer a real-time service and access to our full historical testing. We just looked at that one little historical test today, changing the date on QS from yesterday to today, or today to yesterday, as it were. Reminder, of course, we talked about the married puts. We talked about the protection for long-term and the proper structure a little bit today, leaving the upside open rather than trying to force income to generate on a consistent basis. And for Mark, we talked about the decision-making process of the income methods. If you pick up the blueprint, that's the full course that discusses the radioactive trading techniques, that proper married put structure, what we look for. There is such a thing as taking too little risk, and the improper structure as well, which you'll be able to lock in these 8 special bonuses whose monetary value actually exceeds the cost of the blueprint. You want to see more about that, go to radioactivetrading.com/EOY, or you can just go to radioactivetrading.com and click the products tab in the top corner. In addition to that, for Maurice, of course, we talked about the free education. You can visit the archived webinars page at any time. It's powerop.com/webinars.asp. It is a public page, but some of the more recent presentations are only available to PowerOptions subscribers. But of course, you can go to YouTube, as we showed Maurice, search for PowerOptions. All of our videos, most of our videos are posted there to the public, except for members-only webinar special presentations and some of the unlisted presentations that are there as well. But there's a lot of information, and you can even search just on YouTube on our channel for covered calls, market sentiment, collars, and you'll see a listing of the videos. I tried to be as diligent as possible as keeping the strategy that we're discussing in the title of the webinar or the video that's posted to YouTube. So you can just search for that and you'll be able to find all the videos on this particular strategy as well. Ladies and gentlemen, thank you for joining me for our special Hump Day Wednesday afternoon open forum Q&A session. If you think of any questions later on, send me an email to support@powerop.com or support@radioactivetrading.com. Remember, you can call us during market hours at 302-992-7971. Any trial member or subscriber can also schedule a coaching session at any time. That's a free 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. I will be honest with you, I don't think there's going to be a wide amount of coaching sessions available next week due to the holidays. I do have 2 tomorrow morning, but of course none on Friday and none Thursday afternoon. And I'm not sure what Ernie's schedule is, but my schedule is limited next week for the coaching sessions. But again, you'll be able to find it. If you can't find it scheduled time, send us an email. We'll try to work something out as well. Take care, everyone. Remember, markets close tomorrow at 1. Do your rolls or adjustments before then. Have a happy holidays. Stay safe. Wear the mask, of course. Wash your hands. Stay healthy, most important. Enjoy the time you can with your family members. Have happy holidays. Merry Christmas. We'll be seeing you soon next week for other presentations. Our next open forum will actually be, as I mentioned, next Wednesday on the 30th, because the markets will be closed on Friday due to New Year's Day. Good night, everyone. Take care.